Good morning and welcome back to the Money Advantage podcast. Bruce, thank you so much for joining me here today. I love that we have these conversations on a weekly basis for the most part, and really being able to dig into the root of helping people to understand how to be in control of their financial situation and really bring awareness to the things that they need to know so they can make the best financial decisions for themselves. So today, we are digging into again the 7702 changes and really what that means for life insurance and specifically for infinite banking going forward in the future as these new products are rolling out. And this is a continuation of a previous conversation that we had a couple of weeks ago on the same topic, and we didn't get a chance to cover everything, and also wanted to talk about some questions that arose as a result of that last show. So Bruce, thank you so much for being with me to have this discussion today.
Yeah, sure. The 7702 change is fairly significant, especially in the death benefit side, which, if you're somebody that values the death benefit like I do, I think it's a loss for the consumer. However, if you have the proper strategy, you can make up for that loss by designing policies with a combination of different strategies. But I think most of the people that are watching the channel are asking more about the cash value and so on and so forth. So we'll dig into a little bit of that.
It's really good. And if you are listening, whether live or after the fact, I just want to thank you for being part of our tribe, for continuing to further your knowledge and education, specifically around the idea of infinite banking and how to make it work most effectively for you, or really how to step into that strategy, not how to make it work. I guess that's not the right language, really how to use the strategy to its fullest capacity to help you accomplish your financial goals. And so that's what this episode is all about. And we just thank you for continuing to grow your knowledge. So Bruce, do you want to start first by giving a little bit of a recap of what we discussed last time, and then maybe jump into the spreadsheet and talking about the history of dividends and what we expect going forward, and then we can cover some of the questions we got on the last show.
Yeah, one of the main advantages of whole life insurance is that there are specific guarantees, and because of the extended time period of the Federal Reserve holding down interest rates for 12 years now, there were some necessary changes that needed to be made by the insurance industry that would allow them to be successful into the future. Now, what's interesting about this whole thing is the guarantees have gone down in most, well, I shouldn't say most products, in all products, and most of them have gone down from a 4% to a 2% guarantee. Now, this has always been something that's hard for people to wrap their heads around, because they think that their cash value should be growing by 4% or 2% or whatever the guarantee is. But that's a gross number. And when I say that, I mean is they're giving you in this case, a 2% guarantee, but then they're taking out the fees to run the company and also the fees that are the most significant in your policy, and that is the cost of the life insurance, or what they call COI, cost of insurance. The great thing about whole life insurance over every other product is that the cost of insurance is spread out through your entire life. So the actuaries can actually project very, very easily what the cost of the insurance is going to be all the way out to age 121. And then they smooth that out through the time period. Now, guarantees in whole life are very comforting, but they're, because of the strength of insurance companies and because of the history, the companies that we work with, anywhere from 115 to 175 years, have always paid dividends. So then you have to ask yourself, well, are the guarantees really realistic? Well, we know they're going to happen, but that's not the only return that you're going to get your particular policy.
Mm-hmm.
And if the death benefit, the future death benefit, which if you listen to the last show, the cash value is the net present value of the future death benefit. So the actuaries are saying, okay, at this age, if you get this amount of cash value, it will grow to equal the death benefit by age 121. That's why they're so confident that they can actually fulfill all these guarantees. And so if you pull down the death benefit, then that simply means that the insurance company net or future value, not the net present value, but the future value of the death benefit is a lot less. So they have a lot less liabilities on them. So if they have a lot less liability, they should be able to maintain the current dividend declaration or dividend rate. So in the past, the dividend is made up of the guaranteed plus any of the net profits from the insurance company. Let me say that again. The dividend is made up of the guaranteed plus any of the net profits of the insurance company. So if in the past, let's just say it's a 6% dividend, in the past, if it was 4%, then anything on top of that was actually a 2% net profit of the company to equal 6% gross dividend. Now, I still believe that if it's a 6% declaration, the 2% will still be there, but because they have lesser future liabilities in the form of smaller death benefits, they're still going to be able to play close to that 6% dividend, if not increase it as interest rates go up.
I think this was really interesting to me to begin to understand that if they're making a reduction in the guaranteed interest rate growth of your policy, that does not necessarily mean that they're reducing the declared dividend rate. And
Correct.
So what they're doing is reducing the guaranteed portion of the total declared dividend. And we see that it looks like they're going to maintain the total declared dividend rate, just changing the distribution of, or changing the proportion of how much of that total declared dividend is a guaranteed block of interest and how much is the non-guaranteed dividend portion. And so really what that ultimately looks like is that we don't expect a lot of change in the total growth rate of your cash value, even though the guaranteed growth rate is lessening. Is that?
I would say it is true if interest rates don't move at all. That is true.
Okay.
But if interest rates move, which I believe everybody believes they're going to move. Now, there's some contrarian views of that I've been studying the last week or two that says, well, interest rates can't move that much because if they move, then our debt is going to crush us. But what we're trying to convey in this particular podcast is if the 30-year Treasury goes from, and at the time of this, it's somewhere around 2%. 30-year Treasury is somewhere around 2%. And it goes to 3%. A lot of people would say, well, that's not really moving that much. So how can that make a difference? But once again, as our good friend Todd Langford has proven over and over, that's not a 1% increase. Mm-hmm. That's a 50% increase of 2. Mm-hmm. Because 1 is 50% of 2.
Yes. If you parse out that logic, yes.
So even a 1% movement in interest rates should then give greater returns on the bond portfolio. And this was reinforced by one of the chief investment officers of one of the companies that we use that I had dinner with. And I asked him, I said, we actually saw this in the 80s and 90s as interest rates came down, bond values went up. And dividends went up. And I think we're going to talk about that in a 12-year period. They actually went up about 280%. The cash value actually went up. And I said, but in a increasing interest rate environment, bond values are going to go down. So which one would the insurance company prefer? And without hesitation, he said, we would always prefer a rising interest rate environment. That will help dividends even more. And his rationale for that was that insurance companies will hold bonds to maturity. So they're really not seeing a negative yield or discount, what they call discount, on the par value of the bond because they don't have to sell it. That's only a real loss when you sell it. And they have multiple cash coming in every month to buy new bonds at the higher interest rate. So he was very adamant about that any move in interest rates going forward would actually be beneficial in the dividend returns.
I think that is a fascinating idea. And I know we've discussed this multiple times before, but the connection between interest rates and bond prices, bond rates, and dividends is a very fascinating one. And Bruce, do you think is now a good time for me to show that chart?
Sure.
For historical purposes? Okay, so what I want to do is I'm going to pull that up and hope that I'm sharing it correctly. And then I will have you talk through what we're looking at on this chart.
Sure. And as Rachel does this, we're not guaranteeing that dividends are going to go up. We're just showing you historically that, and this is one of the big things that Rachel and I have been trying to talk about in this podcast for years, is illustrations are not contracts. They are simply snapshots in time. The one thing we know from our experience is that illustrations are not going to pan out the way they say they're going to pan out. Mm-hmm. So when a person looks at an illustration and says, oh, I'm comparing X company with Y company, oh, I'm going to go with Y company because they have a better return, that return is only a projection. They're projecting at what's called the current declared dividend rate of 100% of that current declared dividend rate. Matter of fact, one of the companies that we use over the last 4 years, because they did ratchet down interest rates very early in the process, they started raising interest rates. So some of the policies we did just 3 or 4 years ago have already seen an improvement in dividends because the declared dividend rate has actually gone up with this particular company, where a lot of other companies have actually ratcheted them down only in the last couple of years. So as you can see,
meaning just for somebody who's maybe not as familiar, what Bruce is saying is on the illustration, at the time that you put the policy in force, they project what they expect dividends are going to do for the rest of time based on today's environment. And so that's where it's just a projection. It's a snapshot in time. But right. When you actually live out that policy and you get into the reality of living year 5 and 6 and 7 and 8, those years are going to have a different actual dividend applied to your policy than what was projected on your illustration, because you're now living out time and you're walking it out instead of just expecting or projecting the future.
Correct. And this one was from 12 years in the early 80s. And you can see on the first 3 years, if we go from, we have to skip the guaranteed cash value because that is with no dividends. So if we go to the cash dividends, which is right there, and that's without the paid up additions. If you go to the cash, you can see that the first 3 years, they illustrated or projected that
You're
it was
talking
going to
about
be
here, right?
this amount, correct? And then the actual dividends were exactly what they illustrated. But if you know anything about that time period from 81 through 83, President Ronald Reagan, he actually influenced the Fed chair to bring down interest rates artificially. And what happened there is now the bonds that were bought in an earlier time period became more valuable, because if you had a 9% bond and now you can only go on the open market and buy a 7% bond, and I'm just making these numbers up to illustrate this. Now a person could sell their 9% bond to somebody else at a premium to get that yield of 9%. Well, that is more money into the coffers of the insurance companies. They did the same thing. When that started to happen, you can see in 1984, the actual dividends all the way through 93 actually were a lot greater all the way to 1988. You can see that the 1988 was actually that's before then. It was that's right at 100% difference, but before that it was actually more than 100% difference. And then they kept going up at about 100% on the cash dividend on the base, until we hit it 1993, where it's right at 100%, a little more than 100%. However, if you go and add the paid up additions with the next column, you can see that you do increase the cash value by even more.
So you're looking at the total cash value column, not just the dividend column, right? You're looking
Correct.
at the last column here.
The actual column, actually, I was talking about. And as you combine those two, as we had them stack on top of each other, that the insurance company compounds the dividends on top of that. So now you can see at the very bottom in 1993, they illustrated 195,847. But what the cash value was just after 12 years later was 252,887. So if we subtract that from 195,847, then divide it by the projection, that is a 29% increase over what was projected over that time period. So you had 25 or 29% more than what was projected. Now this works in both directions. So some people that bought whole life insurance policies in 2007 and then saw the financial crisis, their policies have not performed as well, and their actual dividends were potentially lower on certain companies. But
and what was projected on the illustration?
Than what was projected on the illustration. So that's why we always say the illustrations are simply snapshots in time. What's most important in all this is not looking at what the illustration is going to do for you and think it's gospel. What the most important thing is to get started on your alternative to a bank, so that you're storing capital, so that you can take advantage of the stored capital to then do something else with it in the future. Whether that is to start a business, whether that is to pay your house off and then redirect the money, whether that is to buy your car so you don't lose the interest that you have been sending to banks, whether it is to fund other investments. What is important is not the illustration, but to actually get started. I've said this on the podcast before. We've had literally dozens of clients over the years say, I wish I would have started this sooner. And Nelson Nash used to always, Nelson Nash used to always say that the most important time to plant a tree was 70 years ago, but the second most important time to plant a tree is today, because you don't want to be 10 years down the road and keep saying, well, I should have started this 10 years ago. I should have done this, because these things are going to perform. Just at what rate will they perform? And the rate of return is not as important as just accumulating capital. That is the most important thing. Your capital is going to lay somewhere, so it may as well lay in a place that you can get tax-free returns and other benefits, such as a death benefit.
Bruce, are you finished with this illustration?
Yes.
Or not? Let me take off my word. This image, it's not an illustration.
Right.
It shows illustrated values and actual values. Bruce, two really, really interesting things. As you were talking, I was realizing, and I would like to run this past you in live real time. And usually this is something I do beforehand, but I was kind of having the thought as you were sharing, in a lowering dividend, a lowering, lessening, shrinking interest rate environment, like we just showed on the illustration. It seems to me that the growth is more so coming from the ability for the insurance company to sell basically their bonds that have appreciated in value, because the interest rate's going down, the bond is appreciated in value. It's kind of like if you're in real estate, you said, well, it's opposite of real estate in a way, but the interest rate's coming down, therefore I can sell for the current holdings that I have for a higher rate, and I recoup the appreciation. And so they're driving growth of the policies based on appreciation of their current assets.
Correct.
Then what I'm hearing is that when we're in a rising interest rate environment, which we expect or can, for the foreseeable future, expect to see, at that point, now the growth of the dividends within the life insurance company is more so coming from the long-term holdings, or like the cash flow, rather than selling appreciated assets. Would that be a fair comparison?
That is fair. Yeah, that's very fair. And I don't anticipate, from all my research and talking to different people, I do think inflation is going to go up. And I do believe that the Fed will inch interest rates up, but they cannot raise them too much, because our debt would then be too bad in the United States to pay. So then there's only one other way to handle this, and that would be to raise taxes. So then you have to say to yourself, what is one of the best ways then to position yourself so that you can take advantage of that? Well, that would be to have some of your money stored in a place that grows, but it grows tax-free. And so either way, if you think interest rates are going to go down, then this place to store money, I don't think is going to go down very much more on the dividend side, because we've been at close to zero interest rates for 12 years, and the insurance companies have performed fine. If they're going to go down, then you'd want to store your money at some place where the government, if the interest rates go down so that they can do their debt, service their debts, then you have a place to store money that is sheltered from taxes. Mm-hmm. And it's also a place then you have to store to get other investments. Mm-hmm. If interest rates go up, well, then you're going to say, well, that means that, yes, you're going to get greater returns in your life insurance dividends, but you're going to probably pay higher taxes. So in each strategy, it's simply not an investment. It's just simply a place to warehouse your money for the next place you're going to deploy your money. Whether that, heck, with business owners, a lot of them tap our cash value for their income taxes every year, their quarterly taxes.
Which those income taxes are not on their life insurance growth, but those income taxes are on all of your other revenue streams in your business and personal life.
Correct.
Just to share from personal experience, and many of our listeners have heard me talk about the history of where Lucas and I were storing capital, because we all need to store capital somewhere. We were storing it in gold and silver back in the 2008 timeframe. And we stored quite a bit of capital. And we realized then when we needed it most, we started a business and we thought, now we need to use our capital to generate cash flow. We were in a situation where it wasn't very liquid and it had lost about half of its value. Plus we had to pay a premium to sell it. And we were in a situation that had not been an ideal store of cash. So looking at the big picture landscape, we realized the need for liquidity and the need for a safe place to store that cash that we could access and use along the way. And that's really what we're talking about for business owners, especially as you are needing capital to invest back in the business. Maybe you want to expand a product line, you want to do a marketing campaign, you're acquiring another business, maybe within the supply chain, so that you can control the entire supply chain of that industry. And you're in a position where expansion in the business requires capital, and you need that capital to be accessible for you. And also from personal, just sharing from our personal side of things, my husband Lucas and I are about to start another whole life insurance policy. And even though there are these changes right now with the lowering of the guaranteed growth rates or the guaranteed interest in the policy, we are looking at using the new policies because we believe that that still is a good way for us to grow capital and store capital. So we're not in a rush right now to say we have to get in before the products change. We actually are in fact using the new products because we're looking at this product as a long-term store of cash, a generational wealth builder, and a way to have a death benefit as well that will end up paying out to our heirs in the future. So I'm hopeful and excited, not just about the current new policy that we're putting in place, but for the next policy that we're already looking forward to placing as well within the next few months. So that's just a little bit from my personal side. I love, Bruce, that you're talking about tax advantages. And just for somebody who maybe is not as familiar with whole life insurance, can you just briefly, just real in a compact way, share what is the tax advantage of using whole life insurance as a place to store cash?
Well, dividends and interest within a whole life contract are not taxable according to tax law 7702 up to the cost basis. And cost basis is simply how much money you put into the life insurance policy. Once you go past the cost basis, and that's only if you take them out as a distribution. Mm-hmm. If you take them out alone, the loans are never taxable. And so what demonstration that Nelson did for us, one think tank, when he was about 86, when he started drawing some of his retirement, and I'm using retirement very loosely because Nelson really never retired. He just kind of slowed down. When he started drawing some of his distributions for retirement, he did up to his cost basis in some of his really old policies that he had taken out in the 50s, and where he was only maybe putting in $25 a month. And so then eventually they got to where they were up to where what he had put in. So the cost basis. And he said at that time, he just simply called the company and said, from now on, I don't want to do withdraw it, I wanted to actually take it out as a loan. And this is where people get they go crazy. Like, I don't want to have a loan. I don't want to have a loan, you know? And this is not a loan like a unsecured loan that you would have for your car or your credit card. This is a leveraged up loan. So you've put X amount of premium dollars in, and your death benefit, depending on your age, your gender, and your habits, is going to be 10 times, 12 times, even 6 times, if you're older, greater than what you put in. So even if you have a loan, even if the loan's growing, upon your death, they simply will pay the loan off with the death benefit, and there will still be significant death benefit left for your heirs. So it's not the same kind of loan that people think about when they think about it in their daily lives.
Yes. And also, when that death benefit pays out, that is income tax free to your heirs as well. So you're getting tremendous tax advantage. You're also getting the ability to borrow capital and have that cash value continue to grow uninterrupted, with dividends and interest continuing to compound even when you have a loan against the policy, which gives you a tremendous benefit because you're being the bank and you're stepping into this role of controlling capital, which then gives you the power to not only pay interest, you're also earning interest. So all of that being said, I think we've covered a lot of ground here. We have approximately 10 minutes until we need to wrap the show completely and have a hard stop there. So I want to cover a few of the questions that we had on our last episode that we discussed, the 7702 changes, and some are questions, some are comments. I'll just kind of take them from the top. Is that okay with you, Bruce?
Sure.
Okay, so one person named Lucky Charms on YouTube said, have you seen IUL illustrations where the cash value catches up to the money you put in before 10 years? If so, what company? Bruce, I'll let you go ahead and take that.
Short answer is yes, but it's an illustration. It's just what they're illustrating. And frankly, IULs, and I've sold IULs, and I will continue to sell IULs for the proper strategy, but infinite banking is not one of them. And also, you also have to have the ability to bring more capital to the table than what you're illustrating. Why? Because they are illustrating these, most companies now are illustrating these at 5.45 uninterrupted index crediting for that time period. And we all know that the stock market doesn't do that uninterrupted. And it's not an average. You can go back and look at some of our other shows about average versus actual. But the short answer is yes, I've seen it. Do I believe it's going to happen? No. Just like whole life is not going to perform. The difference is the IUL has other charges that can really eat into the cash value. They are the cost of insurance is a 1-year renewable term, so it's going to go up every year. And there's also fees to buy the options within the policy so that they can make sure that you never lose money, but only gain money. If those are sustained, if we have a sustained years with the stock market index not performing the way that they thought it was going to perform, then those options are going to become more expensive. And they have the right per contract to raise those fees. And so that's why we don't use it for infinite banking.
And then also in specific companies, we don't usually discuss publicly on YouTube or on any live platform. When we're talking with an individual person about the strategies that work for them, we will look at the correct companies, life insurance companies, to be able to use the strategy most effectively for that person's personal needs. Also, let's go here. Denzel Napoleon Rodriguez said a client can now put in more cash for the same amount of death benefit. And yes, that is true with the new products.
Yeah, and Denzel understands the products very, very well. Unfortunately, or fortunately, whichever way, Denzel is young. Most young people don't value the death benefit. Yes, this is a true statement, but a person that wants more death benefit, you're going to need to work around strategies to actually do that. Some people actually see this as a negative because people can't have as great a death benefit
with that particular whole life insurance policy, and which that does mean that ultimately, if you're looking at insuring for full human life value, you're going to need to be considering additional term life insurance as well. And that's almost always the case, but we want to be in a position where you're valuing the death benefit and you are creating the opportunity to recover everything that you would have made in your life and provide that amount of capital to your family and loved ones if something were to happen to you, or I should say when. All right, this was just a comment here. AJ Rodriguez said, thanks for this succinct approach to understanding the changes. Bruce, I think that was one of the best descriptions for cash value I've come across. This channel has a knack for making connections in my thinking. I appreciate the time and effort you put into providing this. Thank you, AJ, for sharing those thoughts, and I appreciate you listening.
Yeah, AJ's always he's always got great comments, and we do appreciate him a lot. And I'm glad that he found the description of the cash value to be helpful.
Excellent. Yes, thank you. And then we have L. Henry. Can we still use the PUA method with newer MEC rules? And how long do I have to get involved or lock in on the higher return rates? Or am I too late? The rates were 4 to 6% from what I saw, but now they're changing. Can I still do the IBC with these changes on the horizon? I think this is one of the most important questions. So Bruce, let's just see how much we can share on this.
Yeah. I mean, we don't represent every company, but I have access to every company, but I've chosen only to focus on about 10 or 12. And then we only use about 3 consistently for a variety of reasons. But yeah, there's no change in the PUA method. People that are getting, hung up on these rates of return, really shouldn't be hung up on the rates of return. And to answer his question, can you still get in? Yeah, there's a couple of companies I think that are not going to put this in till January 1st. Many of the companies have already switched over because January 1st you have to switch over by January 1st, but many of them started before this. So yeah, there's a few companies that you could still, but you only have maybe 6 weeks to get this all. And I just don't know if it's worth it other than the death benefit.
What do you mean by that, Bruce? You don't know if what's worth it?
I don't know if it's worth trying to rush and get it done.
Yes, that's what I thought you meant. I just wanted to clarify.
By the end of the year, just so you can get into the guaranteed rates, because as we said earlier, I don't think the guarantee rates are going to affect the overall dividend rates. I just believe that the guarantee rate is helping the insurance companies with their long-term liabilities.
I think one thing that's really important about this is that you will hear and see a lot of noise from people specifically in this time of transition that are capitalizing on fear and scarcity and saying, if you don't get started right now, you're going to miss an opportunity window. Right. And the challenge with that is no, infinite banking is not going away. There's been changes to the financial landscape and the economy as a whole so many times since the beginning of life insurance companies until now, and infinite banking still works. The strategy of maximizing the cash value in a whole life insurance policy, using paid up additions, using it as a place to store cash, that concept is not going anywhere. And we will dip and sway and will change as needed. But what I mean by that is that there might need to be a small tweak on policy design. There might need to be, you might need to fund a policy with more premium than you had thought of originally, or less premium and supplement with a term policy. There are always strategies. We will find ways to best provide you with the guidance and the direction to maximize your money and do the most with it life insurance companies will continue providing products that benefit you and allow you to store capital and create that legacy. And life insurance, infinite banking is just as strong today and will continue to be strong in the future. Bruce, it's about the top of our time here. We had one more question here. This was from Johnny saying, if you already have a convertible term policy, when converting portions of that policy into whole life, must it convert to the new product, or would someone be grandfathered into the old?
Yeah, the short answer is no. I don't know any company that's going to grandfather it in. And the reason that they cannot grandfather it in is the actuaries cannot possibly price that in, because they don't know what the future products might be, or the future interest rate environments may be. So all convertible term is converted at the products that the life insurance company has at that given time. That's the short answer.
I'm glad we had time to cover these. This is great. So if you are worried about the 7702 changes, if you are wondering what is going to happen with the landscape of infinite banking and being able to use whole life products, I hope this answers your questions. I would love to hear your thoughts on this show and your questions for just how to use infinite banking best, how to maximize your financial control the best, how to be in the best position, not only for yourself to create time and money freedom in your own lifetime, but to pass on a legacy that your kids can continue to build upon in future generations. We'd love to hear your questions about any of these things. You can do two things. One, well, you can do lots of things, but here's the great options for getting answers to those questions. First, you can subscribe to the channel. Specifically, if you're on YouTube, please subscribe. This helps you to see more of the content that we are creating and be able to get the answers you need. You can comment below this video and ask us your questions. You can also comment or ask a question by emailing us at hello@themoneyadvantage.com. We'd be happy to address your question on a future episode as well. Or you can directly book a call with our advisors. And you can do that by going to themoneyadvantage.com. Right on the homepage, there's a button that you can click to access our calendar and schedule your first conversation. And this is just a chance to get to know you and find out if we are a good fit in working together, if our philosophies align, and if we can help you accomplish your goals. We will be very clear with you that yes, we can, or no, we cannot. And so this is a risk-free opportunity to have a conversation and really explore what your next best steps are. Thank you so much for listening to the show. Thank you again for being with us on this podcast. And Bruce, before I close us out completely, is there anything that you would like to share?
No, I mean, it just gets down to, once again, there's always been changes in the industry. The most important thing is action. So that's about it.
Excellent. Take that action. In closing, remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.